Today, we will talk about the Foreign Account Tax Compliance Act, FATCA, which requires U.S. citizens to file annual reports on any foreign account holdings and pay any taxes owed on them to prevent tax evasion. The Foreign Account Tax Compliance Act is a law that requires U.S. citizens living at home or abroad to file annual reports on any foreign account holdings they have. The main goal of FATCA is to stop tax evasion. The Foreign Account Tax Compliance Act was signed into law by President Barack Obama in 2010 as part of the Hiring Incentives to Restore Employment, HIRE, Act. HIRE was largely designed to incentivize businesses to hire unemployed workers. Unemployment rates had skyrocketed during the 2008 financial crisis. FATCA seeks to eliminate tax evasion by American individuals and businesses that are investing, operating, and earning taxable income abroad. While it is not illegal to maintain an offshore account, failure to disclose the account to the Internal Revenue Service is illegal since the U.S. taxes all income and assets of its citizens on a global scale. Form 8938 needs to be filed by any American taxpayer with financial assets totaling $50,000 or more. Those assets may be in a bank account or may be in stocks, bonds, and other financial instruments. Foreign financial institutions and non-financial foreign entities, NFFE, are required to comply with this law by disclosing the identities of U.S. citizens with accounts and the value of the assets in those accounts to the IRS or the FATCA Intergovernmental Agreement, IGA. The IRS requires Form 8938 for taxpayers living abroad under certain circumstances. The reporting thresholds for foreign assets vary based on whether you file a joint income tax return and whether you live abroad. The IRS requires Form 8938 for taxpayers living in the United States under certain circumstances. The FATCA guidelines refer to the term United States person or USP. A USP can be any of the following. There are penalties for failing to file Form 8938. The IRS can impose a $10,000 failure to file penalty, an additional penalty of up to $50,000 if the guilty party continues to not file after notification by the IRS, and a 40% penalty for understating taxes attributable to non-disclosed assets. Although the price to pay for not complying with FATCA is high, the compliance costs for foreign financial institutions are also high. Estimates of the costs to UK financial institutions ranged from $1.1 billion to $1.9 billion. Of course, there are always critics of new tax laws. Some critics argued that the cost of implementing FATCA was too great a burden on foreign financial institutions and could even cause them to divest their U.S. assets. American citizens abroad proclaimed that Americans residing overseas need to have assets and bank accounts in their country of residence. Overall, American citizens abroad was of the opinion that FATCA risked a potential loss of trillions of dollars of investment in the United States, the opportunity for American companies and financial institutions to compete in a global environment, and American citizens' ability to reside and thrive overseas. The FBAR and FATCA reporting requirements are similar, but there are several significant differences. Some assets should be disclosed on one form but not the other, and some must be disclosed on both. FATCA impacts all U.S. taxpayers who have assets held abroad. That includes citizens and green card holders as well as businesses owned by U.S. citizens and anyone that spends a certain number of days per year in the U.S. and has foreign accounts. There is no way to avoid FATCA if you are an American taxpayer and have assets that are held in foreign financial institutions. The Foreign Account Tax Compliance Act requires U.S. citizens living at home or abroad to file annual reports on any foreign account holdings and pay any taxes owed on them with the goal of stopping tax evasion. Here are 4 key takeaways. 1. The Foreign Account Tax Compliance Act, FATCA, requires U.S. citizens to file annual reports on any foreign account holdings and pay any taxes owed on them with the goal of stopping tax evasion. 2. The tax revenues brought in by the FATCA pay for the business incentives introduced in the 2010 HIRE Act. 3. Form 8938 is used to report any foreign account holdings, and there are serious penalties for not reporting them. U.S. residents who do not report their foreign account holdings over $50,000 in any given year are subject to steep penalties. 4. Critics of FATCA claim that it places an unfair burden on foreign banks and financial institutions that are expected to report on the assets of their customers. Hope this would help. Thanks for watching.